So welcome everyone. My name is Marcia Dawood, Chair Emeritus from the ACA and also an advisor now to the SEC for Small Business Capital Formation. So I am super excited to be talking to you about this topic with our very, very special guest, Woodie Neiss, who is the principal of Crowdfund Capital Advisors, and he has a lot of information to share with us. So without further ado, we are not going to waste any time. I'm going to turn it over to him. Please put your questions in the chat. We will have a lengthy Q&A at the end because I'm sure after you see all of this wealth of information he has for us, you're going to have a lot of questions. So Woodie, take it away.
Thank you, Marcia. Thanks, everyone. It's great to be here with you. Today, we're going to be talking about investment crowdfunding. This trends report is an abbreviated version of a 150-slide deck presentation that we have that sort of captures everything in our annual report here, which is 150-page whole write-up of what happened in investment crowdfunding last year and leading up to last year. So there's a lot of data. I can't go into all of it, but I want to really give you the highlights of what's happening in this industry that is really growing and scaling and filling a void in the marketplace. Okay. Just a little bit on me. You know, I help write the law for investment crowdfunding. I'm an entrepreneur. I had started a company called FlavorX and sold that. Sat down with two friends of mine from Silicon Valley, crafted the framework for investment crowdfunding. I was living in DC at the time, so it was easy for me to get down to the SEC in Capitol Hill, talk to the people at the SEC. We testified in front of Congress. We did all the lobbying in the House and the Senate. We wrote the versions of the bill, wrote the compromise in the Senate, and we were at the White House for the bill signing ceremony. At the time that the industry launched in 2016, my background's in databases. So I created a database that aggregates information on all the companies that are raising money online. It's called CClear. It represents a 100% complete data set of all the companies that are raising money. We collect 125 data points on each offering, financials, industry valuation, investor sentiment, which is a new metric that is captured for the first time in any private capital market transactions, because we can see the number of investors on a daily basis and the total amount of capital that's being committed. We also have flags for women and minority status. And so we enrich the data. All of this went over to Bloomberg Terminal, where we plugged into it in 2021, and we license and sell this data and reports to individuals. Our methodology is really pulling information from the offering documents, getting information from the platforms themselves on the offerings, and then comparing what's happening and doing analysis on really just the Reg CF side of things. We look at standalone Reg CF offerings and parallel offerings. So Reg CF offerings that are doing a 506C, which is an accredited investor crowdfunding offering, alongside a Reg CF offering, which is really the retail side of it. We look at deals based on where they're located, if they're pre or post revenue, startup versus established, a lot of valuation analysis, and a lot of what's happening in all the different industries and sectors. Just as a quick highlight, there's been over 6,800 companies that have run 8,000 offerings. So companies have run multiple offerings in the space. Currently, there's about 600 active offerings on a daily basis right now. There's been 1,800 cities across the United States where these offerings have taken place. $2.2 billion has been invested into these companies that have been successful. 1.9 million, mainly retail, but there's a lot of angel investors in this mix, have participated in this. These companies have created and supported over 310,000 jobs since the industry got started. Of course, any of these companies buys products and services, and because we can see the financials, we estimate about $6.8 billion annually right now is being spent by these companies in local economies all across the country. Because we can track the initial valuation to their most current valuation, we can see the growth in valuation over time. So a lot of people want to know, is there profit to be made? Is there returns expected? And the answer is yes. There's about $75.6 billion in enterprise value for companies that have gone on for a follow-on round of financing, so we can see their valuations. Just as a point of reference too, there were 3 IPOs out of this data set. Last year, there were 5 mergers or acquisitions that we know of. So there are exits starting to happen. We're 7.5 years into it. That's about right for where you expect these exits to happen. The compounded annual growth rate for the industry right now is about 59%, so it's not slowing down. This chart shows you how deal count has been increasing over time. There was a slight pullback in 2023. I think issuers were sitting on the sidelines trying to time the market, wondering if it was right to go out to investors to raise capital because we had all these fears with inflation. We had the SEC raising the interest rate. And so I think a lot of issuers were like, well, let me hold off. Now, of course, we think things are going to change in 2024 because there's $6 trillion sitting on the sidelines. I think there's a lot of stability that's come into the marketplace with people thinking that we're in this soft landing area. And I think that's going to bring more investors in. Plus, we do a lot of work we have our own venture capital arm. And we see how 2024, a lot of VCs are probably going to be investing in their portfolio companies or looking for deals where the valuations have come down. So down round opportunities. That's going to leave a lot of opportunity for this seed and pre-seed area for issuers to come into the marketplace. So we do think there's going to be an uptick in 2024. This chart just shows you what's been happening on a quarterly basis. To my point that I think things will pick up in 2024. If you just look at what happened in Q4 of 2023, you'll see that reverse bar line there. It takes about 90 days to put one of these offerings together. So you've got to think back 90 days what people are thinking. And we'll see if this trend still proceeds. If you compare what's happening in investment crowdfunding with PitchBook, the yellow line is what's been happening with PitchBook. And, we all saw in Q2 2022 how VCs just sort of pulled the plug and they withheld a lot of their investing. And you guys might have experienced the same thing as well. But if you look at the trend line of what's been happening in investment crowdfunding, the funded deals continues to increase over time. And there was a spike in a lot of deals in Q2 2022. It fell off because I think there's a correlation between the two, of course. But we're generally seeing an uptick that's happening over time, which is sort of opposite of what we're seeing in the angel and seed side in what's happening in PitchBook data. I think this is an important point. A lot of people ask about the risk profile of the companies coming online, and you can look at it from 3 different perspectives. How old are they? Are they startup or established? Or are they pre or post revenue? So this slide is really meant to go right into the age. When the industry started, these companies were very risky. They were like 2 years old, so the riskiest. Now we've got companies, the average age of these companies is over 4 years old. So the age demographic, which means, the risk profile is changing of these companies. If you look at it from that point of view of, are they older than 3 years old, which is an established company, or less than 3 years old, which is startup territory, according to the way banks look at, lending, you'll see how the risk profile is changing over time as well. We've got more established issuers coming into the marketplace. In the beginning, it was only 26% of the companies were established. Now we're at 47% of them are established. So again, we see these more established, less risky type of companies coming to the marketplace. If we look at it from the revenue perspective, in the beginning, it started out with less than $250,000 in revenue. Now these companies that are coming online to raise capital have over $1 million in revenue. As soon as they get, $2-3 million in revenue, now we're talking about a Series A type of round of financing. So it's fascinating to see how companies that are more established with deeper pockets and more revenue are coming online rather than going to VCs for funding. If we look at it from the pre versus post revenue, and this ties into the last slide of, the $1 million, in the beginning, there were quite a few companies that were just pre-revenue. It was very tiny, post-revenue. Now 63% of them are post-revenue. So you can see, again, a shift in the risk profile of these companies raising money online. If this is a fascinating point of it, VCs only fund about 2% of women or minorities. I think angels play a really important role in finding and investing in women and minority founders. The diversity within crowdfunding is phenomenal. If you look at the profiles of the founders themselves, in 2023, 41.7% of the offerings had at least one woman or minority founder. The fascinating thing about this is if you look at the growth from the year in which a company received their investment to the following year when they file an annual report with investors, and we track the annual reports as well, so we have that data, we can see on average their revenues grew 284.5%. So that's phenomenal. I think a phenomenal data point that proves that, people are investing in these companies and these companies are growing and scaling. I think that this point plays into that last point in terms of if they're getting money that allows them to live longer. But if you just look at what the Bureau of Labor and Statistics says, 50% of all companies, new businesses, will fail within 5 years. But what we did is we went through the entire data set of all companies and we went to see if they're still in business. And so when we were done with our analysis, we found out that 17.8% of them have gone out of business. So the longevity of companies that are funded through investment crowdfunding is much greater than those that are just your standard companies that start out and fail within the first 5 years. The 2023 was the best year despite fewer offerings in terms of investments. It was about $560 million. I think ACA members did 600 and something million, so it's about 80% of that. But of course, this data is really a subset in many ways of ACA. And, if you just look at what ACA does and angels do in general, I know Marcia and I were talking about, it's 22 billion. So this is it's a tiny fraction of what's out there, but the point is it's growing. And retail investors, they write smaller checks, but there's many of them. So the dollar amounts of this we expect to just grow over time. Total investments by quarter, they hit a high in 2021. Again, 2023 was really a strong year for it in Q2 and Q4. We think, again, this is a signal that if investors are more comfortable with what the Fed's doing and the markets have really rallied, that sort of money, that $6 trillion that I was telling you was sitting in money markets, can flow into a part of this. No one's going to put all their eggs in one basket, but if you're diversifying, this is an area to diversify into, and we believe that 2024 is going to be a great year for investments. This is the average raise of these issuers. So companies can raise up to $5 million online. We've seen the average raise increasing generally over the past few years. Again, it's hit a high in 2023 at 450,000. So, different types of issues. You have to look at it from, the pre-revenue, post-revenue. This slide just looks at the whole thing, irrespective of age or whatever. And so the average raise is, a little over 450,000. The investors, this is another thing. So investors, they're worried about what's happening in the macroeconomic or geopolitical sense. There was a pullback that happened in 2022 with the whole supply chain and inflation and everything that happened. And investors really sort of went on the sidelines, as VCs did as well. So it's been interesting how we saw this pullback in the number of investors. But remember, I was just telling you that we saw this peak in capital committed. So the fewer investors that were in there were writing bigger checks. So it's sort of like they were placing their bets even bigger in 2023, even though there was a pullback in the number of them altogether. And this shows you how it really fell off from 2021 all the way through Q4 of 2022. And we're seeing these blips in 2023, which I think are tied to investor sentiment in the overall market conditions. I believe some of them are ready to come back. You could probably tell me more on your end how you feel about this if you're ready to start deploying some capital. But I think 2024, we'll see investors slowly start to come back in. I think that means more money will come in. I don't know if we'll be at the area where 2021 is. That might happen in 2025 when VCs really start to come back into the space as well. This one goes to what I was just telling you, where these investors are writing bigger checks. This is the average check size. It was always hovering around $1,000 or below, and it started to grow in 2020. And this year, in 2023, it almost hit about $2,000 for the average check size. What I like about this slide from the retail investor point of view is, investing in these companies is high risk. Many of them will go out of business, even though the longevity is there. You still need to go in it with your eyes wide open. And the fact that the average check size is $2,000 brings me some solace to know that investors aren't risking all of their savings. And so if the average check size stays this way, I think that's a good thing for the marketplace as well, because it shows that there's some logic going into these investments. And this is just showing you how the average check size is increasing and why I think 2024 will be poised for another great year. Success rates are very high in investment crowdfunding, particularly because companies set a funding target, a threshold that they want to exceed, and this is just unrealistically low. I have a big problem with it. I wish they had funding targets that were more aligned with what the company needs to achieve. And I put that as one of the recommendations in the annual report itself. But you have to hit your minimum funding target in order to receive your capital. It's all or nothing financing. So a lot of these companies do set that low, and that's why we've seen these high success rates over time. There's a lot of deals out there that are raising over $1 million, and that's what this chart tracks, is just the number of deals each year that raise in excess of $1 million. One of the research things that we analyze in the reports is what would happen if you just invested in all the $1 million deals, which I don't know is the smartest thing always to do, because you have to do your own diligence on these deals. But there's that's where a lot of I should say papered ROI is happening right now. But what's fascinating is there's a lot of $3 million deals happening in the space now, because you've got this $5 million cap. That's showing competing interest for where the Series A round is. So I think it's sort of fascinating to see how this marketplace is working for seed, pre-seed, and even in some Series A type of cases. These companies, back to that initial slide, are pouring money into local economies. And so we're seeing about, you have to aggregate everything because these companies aren't necessarily going out of business, but each year you add on the companies that were in the prior year funded to this year to the economic stimulus. So that's where that 6.8 billion came from in that initial slide. But just in the companies in 2023 that were successful, it's about $2.7 billion that they pumped into local economies last year. Valuation, I know it's a big question. They are skyrocketing everywhere. You really need to segment this down, and we do it in the report based on pre versus post revenue, startup versus established companies. But this one just shows the trend line of these valuations increasing. We've seen a reset, I would say, in valuations for the pre-revenue companies. The post-revenue ones have a mix of revenue at different stages. And the ones that have higher revenue are commanding higher valuations, of course. And so it's sort of driving that up. And so you really need to dig into it to understand it. But this was showing how they're going up. We've seen the median valuations sort of coming down. Again, this blends in everything. You have to look at it from the different lens. But there's been a bit of a reset that we've seen over 2023 in terms of median valuations. This is the slide that goes back to what I said in the beginning. $2.2 billion has been invested. There's about $75.6 billion of worth tied up in these companies. We're having exits that are starting. People will get the return on investment coming. Some retail investors will become rich off of this. And I think that's the media story that will get the Today Show or any of these morning shows talking about it. The deals are happening really spread around the country, but predominantly in the West. You've got California that leads in terms of both offering investors and investments. It's interesting because California, Texas, and Florida are your three biggest areas where this is happening. So the South represents a big area for a lot of these deals. This just goes into telling you why California is leading in deals, and you can see how New York, Texas, and Florida are right up there as well. This map shows you how deals are being distributed around the United States, and you can see you've got these sort of genomes areas, and we actually cover that in the report itself, where a lot of this activity is happening. And I love this chart too, because it shows, I think, that you don't have to be in Silicon Valley to access capital, because this is happening all over the country. The West tends to have the strongest issuers by revenue. The West tends to have the most investments that are happening. Again, California leads the way in all of this. And that's just, again, what this is pointing out. California, in terms of the number of investments that are happening, there's the capita, the population there is so much greater. There's so many more businesses. Silicon Valley's there. You've got all these people that are starting businesses that come out of Silicon Valley, Google, or whatever type companies that are there that are starting businesses. And it's so there's a lot of logic that's happening there. Again, because a lot of it's happening out west, the average raises by these companies tends to be out west, have the highest as well. A lot of these companies are more established over there, so they can raise more money. Again, the West has the majority of the investors that are taking place in the marketplace. California leads. This is the distribution of investors that are happening around the country. This is showing you average check size, which I think was interesting because you saw how it was going up over time. But if it doesn't matter where you are in the country, it's sort of very similar, with the Northeast having the highest average check size of all of the different regions around the country. And this just shows that the West is leading in economic stimulus. The West has the highest valuations of any area around the country, with the Midwest having the lowest. And we track what's happening through the investment crowdfunding industry through this index that we created called the Crowd Finance 50 Index. So we look at the top 50 deals on a daily basis to track how much money is being committed to them. And that's what this is happening. That's what this chart is showing you. So it shows you essentially investor sentiment in the top 50 deals. You know, it hit a peak in 2021, and it's really stayed pretty steady. It'll be interesting to see what's going to happen in 2024. This is not just an equity play. You know, there are debt deals and there's revenue share deals. Clearly, equity outperforms debt and equity, both in terms of the number of offerings and the capital that's been committed. But a lot of these, you know, Main Street cash flowing type of businesses look at investment crowdfunding as a great way to raise capital from their customers. And it's working. So this shows you that. In terms of the leading platforms, there's 119 that have been registered with the SEC. 83 are active. WeFunder and Start Engine and Republic are the leaders. Seed Invest was acquired by Start Engine. So we'll see some things change, but I haven't sort of seen that in the data yet. But you know, clearly the top three are still the top three. They've been the top three since the industry started. So it's very hard for competing platforms to come into the space and compete with these guys. Again, so that's going to sort of wrap up where I am. We're going to jump into the chat right now. That's what I'm really looking forward to. You know, any questions you have, you can reach out to us. We have these reports that we market on, you know, on a weekly, bi-weekly, monthly, that covers sectors. We have, of course, our annual report, which is 150 pages of just insane analysis of what's happening. And then we launched this Capital Pulse ratings. If you're interested in these deals, but you don't know where to look, we take all of our data and we sort of look at the investor sentiment, valuations, you know, revenues and all that. And we created a machine learning algorithm that compares companies coming into the data set with companies that have graduated from the data set in terms of follow-on rounds. And these are the top 15 offerings that come out on a weekly basis. And I'm going to be holding a masterclass in all this. You can get all the data. And this is, you know, if you want to come back to, you know, if you have questions, I'll leave this up there for to reach out. But, you know, Marcia, maybe we can just jump into the Q&A.
Yeah, there's a lot of activity in the chat. A couple questions have been answered, but let's just start at the beginning. So how are the companies gaining visibility?
Most of them, so they go onto these online investment platforms and they list their offerings, and then it's up to them to do their own marketing. Now, you could hire a marketing firm to help you with that. I haven't seen the ROI happen in terms of the dollars invested into the marketing for the returns that go into the deals. I do see a lot of companies trying their hand at it, but essentially you are in charge of that outreach. So you have to do, you know, emails, you have to do social media posts. You know, it's the game, the rules of the game haven't changed. You know, you are raising money predominantly from people that you know. So you're doing marketing outreach to those people to bring them to the offering page to raise money from them on that page.
Mm-hmm. Yeah. So with these platforms, there's like an accredited a space for accredited investors, and then of course non-accredited investors. And so, you know, what's becoming of that divide between those two?
It's really fascinating. So when the industry started, everything was, grouped together as one. But you could do these parallel offerings. And so then we started to see the platforms do these 506C and Reg CF deals, and they group the accredited investors in the 506C side, and now we have SPVs that all the investors can fall into as a group, which I think works really well as well, because for follow-on investment from VCs, they don't have to deal with a messy cap table. But when you look at that split, I would say like 17% of the money last year went in on the accredited investor side. So a bulk of it is still happening on the retail side in the 506, in the Reg CF side.
Got it. So, geez, lots of questions. So when you were talking about investors, who were you including? Were you including angels, angel groups, VCs, PE? What does that mean?
That's a great question. We don't collect information on the people that are investing because that puts us in a different regulatory bucket, and we are not licensed for that. So we stay away from any PII, personally identifying information. And we only look at the number of checks that are written. Now, we've done a lot of research with issuers themselves and asked them, tell us about the people that have invested in your company. And what we've learned is the majority of people that invest come from their first degree connectivity, about 80%. And then 20% come from the second or third degree. So, a friend of a friend or just no connection at all. But the majority of them are retail investors. There can be a lot of accredited investors. What we're seeing, what's been happening, which has been fascinating, is before it was just anyone grouped together. Now we see how you've got a syndicate lead on these deals, which is typically an angel investor that has said, I really believe in this opportunity. This is how much I put in a prior round. This is how much I'm going to put in. And now we're also seeing VCs syndicating these deals on these platforms, because it's not that the VCs clearly need the money. They don't. What they really like is what the crowd brings to these deals that VCs can't. Mm-hmm. And that's the ability to become a marketing agent for the company, to bring, they go in and keep that company, their eyes on the company in a way a VC can't, because they're actively engaged in these businesses at a local level. So the demographic it's changed, but it includes a lot of this. I don't think private equity is where we're at yet. Perfect example where private equity does play, though, is Boxable. So they build these casitas, prefab homes. They started their online journey through crowdfunding at a $42 million valuation. They've moved way past it now. They are at $3.3 billion valuation doing Reg A offerings. But just think about it this way. If you were an angel investor that put $25,000 in that early round, or one of the rounds that they did through Reg CF, that's worth over $2 million today. And now it's, again, it's in the world of private equity. It's out of this, out of the realm of Reg CF.
Interesting. So a lot of the statistics that you were showing were averages. What are your thoughts on like the median value? Do you have any stats on that as well?
Yeah, it's we debate here, when should we be looking at medians and when should we be looking at averages? We try and focus a lot that we do on medians, particularly when it comes to valuations, because I think that sets a better example of what's happening in the marketplace than an average, because the outliers really skew what's happening there. But in general, with anywhere that we're looking, we're seeing both median and averages amount increasing over time. The thing that you have to, again, segment by is it an equity offering or a debt offering? So you have to break it down by the type of security, and then you have to look at these numbers within that as well.
Got it. Now, do you measure liquidity events from all of these deals you track from 2016? What % are returning capital to investors, and what are their median or average IRRs?
So every year we go to the platforms and we ask them for exits that have taken place. And we get that information from them. A lot of the information is not disclosed. So a lot of the acquisitions is not public information. So we don't know necessarily what went back to investors, but we're not hearing anything negative. I think investors are excited when there's an acquisition because it's happening a lot sooner than, an exit through an IPO. I'll tell you this, that the IPOs that have happened, like many IPOs, I don't think they perform very well after they go public, because now you're beholden to, all these public, reporting and all that stuff. And so I've seen a lot of these companies that have gone public drop off. So I think that the real opportunity is mainly through an acquisition in this space.
Interesting. So there's been a lot of questions about the competitors to the big guys and what's the trend going to be toward the big three. Are they going to just keep growing? Are the competitors going to be able to take some of the market share? And why is it so difficult for some of the competitors to get ahead?
I mean, the only reason I think it's difficult for the competitors to get ahead is people like going to the ones that are proven. The ones that are proven can literally go to all these issues and be like, yeah, we've got a strength in technology. These are all the deals that we've done. These are that, average that we've been able to raise. And so people are sort of like, oh, well, maybe I can raise that. And so I think that sort of drives their decision. Where I don't think it plays in so well with the big guys is, someone in Minnesota. Where there's a local platform there. I think they have the ability to do marketing regionally, and that works well for them in terms of attracting issuers locally onto their platform. But I think, the big guys do the marketing in the space. So if you type crowdfunding, equity crowdfunding into Google, you're going to see, WeFunders, Start Engine, Republic pop up because they've got money to spend on advertising. All of these big guys are also venture funded as well. So they've got money to spend on this, and that allows them to keep that market share.
What about the profitability of those companies like WeFunder and Start Engine?
I think WeFunders had a few quarters where they've been cash flow positive. The same can't be said for Start Engine or Republic. They are investing heavily. They're raising a ton of money and investing heavily, not necessarily into crowdfunding, but into other areas where they see opportunity. So Republic is very heavily digitally focused. They think, tokens and digital assets is where the future is going to be. And so they're investing a lot of money in there. And that, of course, eats into any profit that they're having. WeFunder's just been very focused on, we are Reg CF. This is our bread and butter, and that's why they've been able to have some profitable quarters. But, as long as Start Engine's spending all their money on marketing and stuff, as long as, Republic's working on, expansion globally, I don't know when they're going to have profitability.
Yeah. Now, do you have any metrics on the success by vertical for crowdfunding?
Yes, so we do break down in the report the industries. So we look at that through, how much they've raised, their success rate, and all that stuff.
Got it. What types of startups lend themselves to crowdfunding versus the more traditional raises? You kind of touched on this, but maybe go into a little more detail.
So when it comes to your debt type of offerings, I think it's really your Main Street cash flowing businesses. It's the ones that can't go into a bank and get a loan because they're less than 3 years old, and you have to be over 3 years old in order to get a loan from a bank. And that's where we see that space really starting to grow and scale. The equity offerings, it's, there's two parts. You've got your startups where you've got a team that's coming out of, Google or a university, and they're like, I just have this idea and I want to build it. And so they're raising money based on their pedigree, based on any traction that they've had with successful exits before. And they're raising some substantial money there. And then you've got the post-revenue companies that are like, you know what, I want to bring in some of these retail investors to have them brand advocates for the company. So they're much more established, they're older companies, and they're doing these offerings online really as a marketing effort that brings these investors into their company on their cap table. And then they start using them to say, listen, this is where we need help. Can you help us in this marketing or this outreach? And it's amazing the power, we live in this world of social media today, okay? You can't deny it. Everybody's on their phones scrolling through whatever social media is. If you can figure out how to capture an audience that is on these social media platforms that get them to reshare messages that are important to your company that help you build your business, I think you've done something that a marketing agency that you spend millions of dollars on finds it very hard to do. And these people they've paid you to essentially do that work for you. I mean, it just blows my mind how everything's changing here.
Yeah. Well, so you mentioned about debt versus equity. So there's a couple questions in the chat about, can you comment on the differences? Like, what's the mix between the two?
Yeah, that sort of goes back to the slide that I had over here that shows the debt versus equity. The majority of the deals are, maybe I just went past it, but the majority of the deals are in the equity realm. And we're not seeing, then it's this one right here. Then you've got debt in there and revenue share. Now, revenue share, I think, is a fascinating thing because all it says is we will pay you a % of our revenue over a certain period of time. So you've got Mainvest is the platform that really focuses on revenue share. Honeycomb and SMBX are ones that focus on the debt side of things. And it's really straight debt, they set an interest rate. What we've seen, the trending interest rates has been fascinating as well, because, as the Fed increased the interest rates, that had a trickle down effect to this marketplace where average interest rates for debt offerings in 2023 were approaching insanely high amounts, like 13%. Like, I wouldn't borrow money at 13%, but you've got these small businesses that are located in areas of the country where they've got no other option. Now, what we've already started to see, even though the Fed has not decreased interest rates, is those interest rates are coming down. And I would say they're around 11% right now. So it's not a great opportunity for the issuer itself, but hey, for investors, when I talk to the Honeycomb and SMBX, they have insanely low default rates. Okay, so I think that's a great story for investors that might want to do a portfolio of debt investing. I just want to, invest in, 30 debt deals and get, 10% interest rate on a lot of these. I think that's a great way to be thinking about how you can diversify into this space as well.
And are you defining debt as just convertible debt, or are you also including safes in that, or what are you defining debt as?
Yeah, when I'm thinking of debt, I'm thinking of your straight debt, not your convertible debt. I'm thinking of, loans that people would otherwise go to a bank for.
Got it. And while you're still skimming through the slides, there was a question about, can you break down the stats percentage of crowdfunding deals by type? So like Reg A, Reg CF, didn't you have a slide on that? Reg D, the 50?
I didn't have a slide on Reg D, what's going on in those spaces. And here's the challenge. You can have these exemptions that are being used and companies filing with the SEC that they're going to raise capital under these exemptions. But then it's who knows what's happening. The thing that's great about Reg CF is you have to do these raises on these online investment platforms where everything's public. You can do a Reg A offering, and that can be done through a broker-dealer, and none of the information is public. Now, Reg A deals that are happening online, we get feeds, like Dealmaker gives us access to the deals and money that's being committed to those. But I don't know, of all the Reg A deals, what % of the capital is going to Reg A versus Reg CF versus a 506C versus a Reg D, only because most of that information is not public.
So, what do you think the risk or disadvantage is of doing early stage crowdfunding to angels and VC funding that come around later on?
I think the risks are the same. I don't think they change. You still are looking at early stage companies that are at their early stage of financing, that have the challenges that any of these companies have in terms of, how do I capture market share? How do I compete with investors? How do I raise money? And so the only thing that I think is changing is, if there's one thing I've noticed, is VCs are moving upstream. There's this change that's happening in the marketplace where VCs are, they're raising a ton of money, like insane amount, not of course in the last 18, 24 months, but before that, they were raising a ton of money, which means that they have to deploy a ton of money.
Right.
And it doesn't behoove them to be looking at these little deals anymore, because they spend a lot of time doing the diligence, and they can only write smaller checks. So this is forcing them to move upstream for bigger deals, and they spend their time in that space. So it's creating this opportunity, I think, for angels and the Reg CF in general, for people to be looking at these deals and playing that role now of these early stage VCs. Of course, listen, I'm not going to deny the fact that there aren't early stage VC firms, and a lot of the micro funds that are in the marketplace are focused on this, but those funds are also smaller. So the amount of capital that they have collectively is not as big as these VCs. And I think that, that's really just how I look at it.
So really, since equity crowdfunding has come out, the things that I've heard anyway as an angel is that, well, as angels or VCs, we don't really want to do deals that had raised through equity crowdfunding. There's like this, I don't know, connotation that something that maybe all the people who invested through Reg CF are going to all be now on the cap table, or they're somehow going to find the entrepreneur and ask him 5,000 questions, or I don't know. But there's a lot of criticism around, people passing on deals because of this. So what's your take on that?
Yeah, and when the industry got started, we heard that a ton. And we needed to wait 7.5 years now into it to see if that's true. And I haven't seen one lawsuit. I haven't seen a complaint of VCs that are doing these deals with the crowd now. Now that we have SPVs where everyone's aggregated under, one SPV, that's sort of solved that pain point. So, there's a lot of fear when something gets started, that you have to, spend some time to see if those fears are actually going to come true. And I haven't seen any of them come true. I can respect someone that says this deal's not right for me just because I don't want all these investors, messing with the company. I just haven't seen the investors messing with the company. Everyone's got a full-time job pretty much that's an investor as well. So, they're making an investment in the company, hoping the company does well, wanting to see if they can help support it. And the fact that we're seeing more VCs now syndicating these deals on these platforms, I mean, it's front and center. Like when a VC is in on one of these deals, I think, disproves a lot of that logic as well, that it's not of interest to them anymore. I think, and then of course, if you look at the UK, it's just a ton of VCs working together with the crowd. Like all the fears that we have here were proven out in the UK. And they have much less regulation going on than we have within regulation crowdfunding in the United States. And their industry is just doing incredibly well.
Interesting. So let's turn to diversity for a minute. You did have some data on that. So are the platforms attracting female investors? And if so, are the women investing at the same level? Are there other platforms that are women founded or women focused?
No, that's a good question. I don't know any platforms that are women founded or focused. Which again, I think is like a huge opportunity. Like when people ask me like, they hire us for advisory work, I was like, build a vertical, like build a platform that focuses on a vertical in the space and just market to that vertical. I think in Honeycomb and the debt offerings, we're seeing a ton of women and minority founders, because they're starting these retail businesses. They're closest to the community. I don't know what kind of outreach the platforms necessarily are doing, if any. I just see the fact that there's more and more women founders and minority founders coming into the marketplace. I'll tell you one thing, based on the research that we did in the report, why they represent that 41 or whatever that 40% was that I mentioned earlier, the capital committed to them is about 35%. So there is some bias still in the marketplace towards white men, where they raise more money, they have higher valuations, they have more investors. But when we've talked to the women and minority founders, it's been fascinating to hear that they're raising money from people that look like them. So women are raising money from other women, minority founders are raising money from other minority founders, and there's a lot of logic in that. It's their community, it's who they're hanging out with. So I see more of that happening than per se the platforms doing the marketing to women and minorities.
Interesting. So going down a little bit into the weeds about what we were talking about related to how the funding actually happens and whether or not angels should be scared about this. Is it common shares that they're taking? Are they getting preferred shares once there is a conversion?
Yeah, another great question. So then I would say that the majority of the deals that we're seeing right now are safes. There's a lot of issues around safes. It doesn't have a lot of investor protection, investor interest in them. There's plenty of deals that are common stock. So that's what you're getting, common stock. We do see convertible debt in there, and we do see preferred shares. It's amazing. There's no restriction on the type of security that you can offer through regulation crowdfunding, which is why you have safes, by the way. But people are even issuing tokens, which I think is sort of smart, because the SEC, of course, is not approving any tokens as a security, at least not yet. There might be changing. But you can issue a token as a security through Reg CF. There's a 12-month holding period on it where it can't be transferred. But after that 12-month holding period, those tokens are freely transferable. So essentially, you've created a security token with that 12-month holding period that now can be used in the way that people really want these security tokens to be freely transferable. So I think there's a whole opportunity in that space for people. But to just go back to your point, common shares are common shares, preferred stock. Yeah, it's straightforward, and it's laid out in their offering documents.
Yeah, so it could be that everyone's a little different then?
Oh yeah, very much so.
Just like regular deals, just like non-crowdfunding deals, right?
Exactly. But let me just tell you, the one thing that is I don't know if it's a bad thing, but if you're an angel and you're investing in these companies and you're doing this one-to-one conversation with an issuer, an entrepreneur, you're having a negotiation and you're having a conversation like your valuation really doesn't make sense because your revenues aren't there. Like if we look at all the data of companies at different stages, this is where your valuation should be. In crowdfunding, the entrepreneur states the valuation that they want for that round. So there's no real negotiation going on per se. What they can do is offer a discount to people that come in early. So it's like an incentive to come in at a lower valuation. But I think that's one of the reasons that it inflates the valuations that we're seeing in the marketplace. And I wish there was a better way to do that, where there could be more of a negotiation that takes place that would probably drive down these valuations to more realistic levels. But the way the law was structured and all that, you have to state your valuation. You have to state what it's based on, which literally could be like a whole analysis of why you think it is, and comps to, revenues and income and all that stuff. Or you could be like, I just threw a dart at a board and came up with that valuation. I mean, you just have to disclose it. So it's, I think how you come up with that valuation in the offering documents can either encourage or deter investors. But a lot of these retail investors, keep in mind, have just a relationship with these entrepreneurs and are investing in people that they know and believe in. And they don't have the sophistication around the valuation that, angels clearly do, VCs clearly do. And it's an area that I think needs improvement.
Mm-hmm. So why do you think that so often they're using a safe in Reg CF? And could they do it just like a priced round, or do they have to almost go into a vehicle for the platform to be able to convert it?
That's a good question. I think my sneaking suspicion is that these platforms probably say to these issuers, particularly the ones that are not, sophisticated, this might be their first round, let's just do it easy. A safe, it's 2-page document. You don't have to worry about the valuation until the next round. You don't have to worry about, justifying it, all that stuff in detail. And I think that let's just be easy and go with that is probably getting a lot of these entrepreneurs that don't understand how you come up with the right valuation to use these safe notes. But, that's just, my own personal opinion on it.
Yeah. So do you think that the same model that we kind of have in our brains as angels about, you need to invest in, 30, 50 companies to find the singles, the doubles, and maybe the one home run, and that, 5, 6, 7, 8 out of 10 are going to fail? You think that's the theme for here?
100%. The rules of the game do not change at all just because we've got equity crowdfunding. You have to diversify. You've got to do your diligence and your research, and you have to spread your bets. I mean, so we started a venture arm called D3VC, where we partnered with a data science group. And this is what I was talking about, where we took all the data of all these companies and we looked for signals within companies that were successful and went on for a follow-on round of financing. And we compared those companies with new companies that are coming in to see if they share similar traits. And then we get a weekly report on companies that score highest in the algorithm. And that's how we do our weekly diligence meetings, where we're like, well, let's look at these companies. We always have a series of questions that come out of it because, computers can do a lot of quantitative stuff, but they can't do the qualitative research that you want as an investment team. And so we meet every Wednesday. We just had our call right before this, where we go over the companies in there. And the goal with D3VC is we plan on investing in 200 companies through Reg CF over the next 3 years. So it's a broad net. But when you look at research that's come out of Harvard and MIT that studies VC portfolios, they always say the same thing. The ones that have a more diversified portfolio, that have invested in more companies, always outperform the ones that have invested in fewer. So the goal with us is, capture that boxable that I was telling you about at the earliest stage, hopefully through what's come out of the algorithm and the signals there, and have, instead of one of those outliers, maybe in a set of 200, have 10 of them.
Yeah. And what's your opinion on investing in the crowdfunding platforms themselves? A couple people have said they're investors in different platforms.
Yeah, count me in. I've invested in every single one of them. Only because you have to think of it from this point of view. This industry is not going anywhere, okay? It's here to stay. So if it's here to stay and you've got these platforms that are becoming more institutional, they're not going to be owned by WeFunder, Republic forever. This whole industry is owned by much bigger financial institutions than any of these platforms. And when it gets to the size and scale that they're like, I'm ready to acquire it, they will acquire it. So from my point of view, I've invested in all of them thinking, well, I'll just be part of that, acquisition down the road. But here's the other thing that a lot of people don't know about is, I invested in Seed Invests way back when they first got started, only because I knew Ryan Feit through when we were working on the legislation. Yeah. And Seed Invest said, we're going to take warrants on every company that is successful. And because I was an investor in Seed Invests, I actually owned part of that pool of warrants that was coming out of that. And so every year there's some sort of exit activity or something that pays back through those warrants to me and all the investors that were on the cap table for Seed Invest. So I would look at, which of the platforms have ownership outside of the commissions that they get on these deals, and look at that as another way that you can not only be an owner in these platforms, but also make some money off of the success of the deals on that. I know Republic's got a Republic note going on right now that literally does this for investors that might not want to invest in all the deals on their platform, but want to benefit from all the deals that are successful on their platform.
Oh, that's interesting. So is there the possibility that, like a traditional financial institution might come along and be like, hey, I want to play in this game, and they might actually scoop up one of these guys?
I mean, I definitely see that as the future and where this is all going.
Yeah,
They own the markets. This is part of the markets. They're going to want to own this.
exactly.
That's my opinion.
So there's a specific question in here about a company that is cash flow positive, it looks like, and an AI-based self-publishing tools, but they haven't done any crowdfunding yet. Like how would they go about that if they were already, they're struggling to raise growth capital right now? How could they get help through equity crowdfunding?
So in our monthly report that we cover, we do an industry breakout, and the one that we just did for January covered AI. So all AI related companies that have raised money through crowdfunding. So it's a great resource to just know what's happening. And that tells you which of the platforms are that have raised the most money for AI related companies. I think it was WeFunder. Might be on that top of the list. I don't have the report right in front of me, but again, it's either WeFunder or Start Engine or Republic that have done that. But I would just tell them, go on to any of those platforms, and in the search field up top, type AI and see what pops up, and look for the companies that have raised the most money on their platform. Or you can come to us. It's one of the services that we provide is doing that research on all of the deals in that sector, which the platforms average raises, number of investors, to give people insight into, and then we even do valuation comps, so people can see where what other companies have raised money at, to give them comps for where they might want to price their round to.
Mm-hmm. So what do you think are the trends, the future for this? How big will it get?
I made the soup and the stew and the Kool-Aid, so I'm jaded 100%. It's not going to replace the role of angels or VCs. I think we're going to get comfortable with the role that it plays, and we're going to figure out how to leverage the crowd to bring the angels and the VCs the deals that they want to invest in. So I think the angels and the crowd are going to be investing in these deals. Then the angels are going to be investing in a lot of these follow-on rounds, which also are happening through crowdfunding. But they'll also be reaching out to these really successful deals, being like, I see you guys are getting ready to get to the next level. That's where we can come in. And you have to remember, there's a $5 million cap on how much you can raise through crowdfunding. So by default, that cap pushes people outside of the industry. So we'll be playing in this space. I'll tell you, we are heavily advocating that the SEC, or maybe not the SEC, but Congress, move the cap from 5 million to 20 million. And a lot of people might think that's crazy, but there's a lot of logic in it. There's been very little fraud in the industry. Why? Because the disclosures are there. All of this is happening in front of you. You can't pull the wool. It's very hard over 300 and 500 investors' eyes that are all diligencing a deal as you can behind closed doors, where you're sharing special documents with one investor versus another investor. So if we move that cap up to 20 million, it allows more established companies to come into the space and benefit from the crowd. It allows companies to scale through time. And if VCs are moving upstream, they can now get to the point where VCs can deploy the really, the bigger checks into the space. So I think we'll see this gradual evolution. But a lot of this is also tied to geopolitical and macroeconomic events. If the wars in the Middle East spread and this investor sentiment just drops and the markets drop, well, this market's correlated to that. It's going to drop as well. But if things stay positive, if investors really come back into the marketplace, and take that 6 trillion off the sidelines, I think a lot of that's going to trickle down into this marketplace as well. So, it took us 22 months. No, it took us 5 years to get to the first $1 billion that was invested. It took us 22 months to get to the second $1 billion that was invested. So those 2 points right there tell you what's happening in terms of this industry. And I think it's just going to continue to trend up.
Yeah. All right. Well, we're out of time, but there was a question about typical costs. So in 20 seconds, can you tell us what's the cost, including recommended marketing?
The average success fee for these offerings, I would say, is about 7%. So that's just going to go to the platform. That doesn't include what you're going to pay an accountant for a CPA review if you're raising over $124,000, which will probably run around $3,000. It doesn't pay costs for any of the marketing. We did do one research report a few years ago now, so it needs to be updated, where we asked issuers that were successful, how much do you pay on legal, accounting, and marketing outside of the success fee? And it was 5.3%. So you can take that 5.3%, add it to the 7%. It's not cheap. The more you raise, the more it's distributed, but that's where it nets out about.
Well, Woodie, this has been fantastic. Thank you so much for all this great information. The recording and the slides will be available. And thank you so much to everyone who came and asked such amazing questions. Thank you all.
Thanks, everyone.